we're going to look into the possibility of maybe a recession entering next year. So I don't know what, Chad, your thoughts are for a recession. So let's get into it. Let's see what are the public saying, what are companies saying, and what does history says about past recessions and maybe an upcoming one. Let's see the soft landing. So first of all, who determines a recession? Sometimes people aren't very aware of it, but actually the National Bureau of Economic Research, NBER, is the one who determines officially a recession. And they actually title it as a significant and prolonged decline across the economy, affecting things like jobs, income, production, and retail trade, which is pretty obvious. But I want to get into the more detailed things. What determines a recession? Right now, many of these factors are what investors are actually taking more notice. So starting first with the GDP, which actually reports every 3 months, came in very high and higher than expected at 4%. What is needed? Well, the criteria is that 2 consecutive quarters of negative GDP growth to start. Last year, 2022, that actually happened. And generally a 2% or more decline in GDP over 2 consecutive quarters is a significant factor for a signaling recession. And I put them from most important to least important. Unemployment rate increase. This is what Jerome Powell is trying to do, increase unemployment rate. Right now, it's at around 3.7%, lowest level since 1970. But an increase of often 1% or sustained high rate of unemployment above economic distress. Right now, it says 3.6%, 3.6, 3.7%, pretty low. So I want to get later on thoughts whether you think and Chad thinks we're getting to recession or not.
Sure.
Third, consumer spending reduction. We saw with Starbucks, people buying higher end beverages, Ferrari race as well. The company popping to after earnings, but a decrease in consumer spending, which we don't have right now. A substantial drop in consumer spending between 2 to 3% can contribute to a recessionary environment. This year, there hasn't been a single month where consumer spending has decreased. They actually have been increasing month over month, just barely above 0.1%, a little bit more, but increasing, and that shows a strong economy. The fourth one is a business investment decline. So with the reduction business investment around a decrease of 5% or more in economic contraction. And these reports are actually published every month. You can watch them with website MarketWatch Economic Calendar. The fifth one, industrial production decrease. Well, this one is one of the few ones that have actually decreased past several months. A reduction between 3 to 4% can indicate a recessionary phase and interest rate changes. Well, right now, it can be either to the upside, downside, there's no specific. So an increase in interest rates or another monetary policy adjustment in response to economic challenges can signal a weakening economy. So right now, interest rates are at the highest point since 1970, and the Fed expects to maintain them for more than a year. And that actually is no good. That's why many investors are actually demanding a higher yield on bonds.
Yeah.
Also due to inflation. And so these are the 6 main criteria based on the National Bureau of Economic Research. Not every single one has to be checkmarked to signal a recession, but most of them, no?
Yeah, it's interesting. I don't think in a recession at the moment, just because like markets have been raging, and there's obviously a difference between markets and the economy, but markets have been raging. Prices in general have still been raging. Consumer spending is still strong. Arguably unemployment is like not where we would qualify to be in the situation. But I think that there's kind of like, we're all kind of in the same boat where there's like writing on the wall where that's where we're heading. But overall, our economy still seems quite strong compared to what would qualify for a recession.
Definitely. And Jerome Powell even said that the economy remains pretty strong. Labor market very tight. There's more job demands than like people trying to work right now. There's a lot of hiring. Tomorrow we're going to get employment report Friday. So if it comes above expectations, maybe we can see a pullback in the market, just a small one, because that's what the Fed doesn't want, a higher, lower unemployment rate. So right now, I took the probability of a U.S. recession, and according to this graph that I'm going to show, shows and signals
Mhm.
So there's going to be a recession for the following 12 months. Also, the U.S. Treasury yield curve is still inverted since last year of July. Definitely has made a big upside movement, recovered a little bit.
Mhm.
That's why many of them have signaled that there might not be a recession, and probability has, I put lower probability, but it has actually decreased.
Mhm.
Right now at the peak, well, 25th of July, that's
Mhm.
when there was an 80% chance of having a recession in the upcoming 12 months. As of now, October 30, it recovered, and the chance is 70%. No, and we're gonna see.
Still quite high.
Yeah, it's still quite high, but actually making a recovery. And who's actually? Well, I'm gonna get to that, but the inverted yield curve. Why has it recovered a little bit? Well, the inverted yield curve on July.
Mhm.
See here, there was a negative 1.08 inversion
Mhm.
from the 10-year treasury to the 2-year treasury bond. That meant that the 2-year treasury paid you 1% more than the 10-year treasury, which is quite a big difference. And it actually matches the highest probability rate for a recession on 25th of July.
Mhm.
So at this point. And as of now, actually has recovered a little bit the yield curve. It's at 0.16% down. So the 2-year yield pays you 0.16% more than the 10-year.
Mhm.
Still signals some trouble for the upcoming years for the short term rather
Sure.
than the long term. And
Loop.
will a recession land soon? I like this forecast, this survey that the Federal Reserve Bank of New York with the Conference Board survey made. The Federal Reserve staff actually right now has a 0% probability for a recession upcoming for the next 12 months.
Mhm.
They changed very drastically their view on July. At the beginning of the year, they actually had a recession for the upcoming year. Well, now 0% chance. The yield curve signals a 61% recession. That's because
Mhm.
the past 7 recessions have been the yield curve, inverted yield curve. Economists, 48%. Consumers, 69%. Goldman Sachs, and I took Goldman Sachs because actually it's the lowest bank that has they actually been decreasing the probability of a recession. At the
Mhm.
beginning of the year, they started with a 40%, and right now they stand at a 50%. And comparing it to the highest uh, percentage probability, well, Bank of America, also 2 major banks in the US and the world, from a 35 to a 40% chance, which is also pretty low. And CEOs from companies have a prediction of 84% for a recession. So
Yeah,
yes,
I'm one of those. In both camps. Yeah. um
I would stick with economists, maybe 40%.
I
Economy looks pretty strong, not for a recession, but maybe for a important pullback in the market. Not even like another correction would be fine. So companies seem to be less worried right now because
Mhm.
tracking from the second quarter earning reports, companies citing keywords compared to 2022, the first quarters. Well, there's been a reduction of keywords such as inflation, material costs, economic slowdown, and job
Mhm.
cuts. So I think this is something to make investors more happy, less worrisome about the coming. I like that these metrics they track everything. At the beginning of the year, people were tracking AI mentions on the earnings conferences. Well,
Mhm.
this tracked keywords such as inflation that obviously has been decreasing pretty constantly,
Mhm.
material costs as well, and I think this is a good representation about less worried companies about pro- problems like this.
That's interesting. And I think, oh yeah, never mind, keep going.
Yeah.
We can talk later, but
And I want to see where to invest in a recession. Is there maybe some good sector? And I got the average period returns in 1960 on recessions
Mhm.
that they have been 7. So the only one that tends to be positive are defense stocks that are known as consumer staples, like Walmart.
Fine.
I'm not mentioning Lockheed Martin, all of like war stocks.
I don't think crypto's on here.
Oh no!
Someone's gonna complain about that, but
If you feel that crypto is a good hedge against a recession.
I'm not in the crypto market, so but it's gotten hyped up quite a bit. Now there's been more talk, especially because like crypto's resurged and there's been a bit of a pop. Yeah, it's been a consistent topic of conversation.
Want to see how crypto tends to perform in a recession. We know that in 2020, well, they had a great run to the upside, so like everything. But yeah, so real estate, negative 22% average drawdown, followed by tech, industrial financials. I know that right now real estate has been starting to drop some of it. Has some people still worried, very expensive. But maybe if you were to think that we're on a slowdown period, there have been 11 slowdown periods before since 1960 and only 7 recessions. A slowdown period doesn't mean we're going to enter a recession. Right now, we may be entering a slowdown maybe at the end of the year. In my opinion, a lot of investors are saying it. There has to be a normal pullback. Well, sectors tend to perform pretty well, especially also consumer staples and healthcare, the main company, well, not the main sectors that tend to perform better in the slowdown period, which we're not in right now. Consumer staples and healthcare. And I want to focus on consumer staples being on the first one. This year, they haven't done nothing at all. On the contrary, these are the top 10 companies on the consumer staples, and they have even dropped. Just Costco with an average gain this year of 22%, followed by Walmart, 3 huge companies. Monster, I was amazed by that.
What is up with Monster, man? That's wild. I still can't get over that.
Yeah, and
is Monster the best inflation hedge?
Well, these are the companies the top 10 companies by market cap on the biggest market caps on consumer sector. No, so I put them by return. Sorry, but they haven't performed pretty well. So because maybe we're in an expansion period, and during expansion periods, tech tends to perform better, real estate as well, other sectors rather than consumer staples. So industrials, many of them, and consumer are used mainly to hedge against turmoil events.
For sure. Yeah, this is really interesting, dude. Thank you for putting this together, because it always, again, having the context and having a different point of view and having someone who's a little plugged into macro more, having you break it down, for me, I find this really interesting.
I think it's because I've seen many people like, when do we get a recession? No, recession is when the market enters a bear market. No, that's just a crash. There's several factors. The 6 mains I mentioned that have to be looked at, and I like to look a lot to economic events. I pay attention to those. Tomorrow we get the unemployment report, and I'm going to definitely look at it, especially because with my MES position, and people look at it, and it does have an impact on the market.
For sure.
Yesterday we saw with the Fed rates, and it's one of the main decisions that the Fed rates, the interest rate changes, they left them right now after 11 consecutive increases on the Fed rate. Well, they have now 2 consecutive pauses right now. So I like to pay attention specifically because right now there's a lot of talk right now. Either the market's going to enter recession, it's going to be a hard landing, soft landing. I think there's going to be a soft landing. The economy is pretty strong. But definitely, I believe, in my opinion, and maybe wrong as hell, just like I am right now with my position.
Which is super interesting, yeah. I remember this kind of came up more when people were talking about like stagflation, because I know that there were like stagflation concerns maybe a year ago, a couple months ago, something like that. Which it's when you have high unemployment as well as high inflation, which are 2 things that are not great in combination. But there's a bunch of different factors that are ultimately going to impact like monetary policy, economic policy, and a bunch of different factors that could have like really detrimental like impacts on an economy, right? Like having your unemployment numbers being off, or your GDP being off, or whatever, any of these different sectors, crashing can potentially like goof your whole economy up. But like my understanding, at least, is that the single biggest risk to an economy is inflation. Because when your currency spirals, whatever has an inflationary spiral, that is really, really hard to recover from. There have only been like a really handful of cases where you've successfully recovered a currency that has spiraled into hyperinflation. And so my understanding, at least from a policy perspective, is like getting that under control is the primary directive. because having bad unemployment or having bad GDP figures or whatever, that'll like hurt an economy, but inflation can absolutely kill an economy. So on paper, right, we're actually doing on a global scale pretty okay from a, our CPI numbers. They're not great, obviously, and certain sectors are much higher than others, much more inflated than others, but like on a global scale, we're doing okay.